We run the Section 8 program in the city of LA. That's a very big deal and a very hot topic right now. That generates cash flow. We use that to support our operations, to pay my salary, to invest in buying properties, to invest in building property. You can have that attached to your property. Those are 20-year contracts. They can be renewed. The advantage to you, of course, is now you've got a contract that essentially doesn't guarantee, but more people are comfortable underwriting that. We don't really know, and I should say we don't have the details. My understanding of what was proposed was not to eliminate it in totality, in the sense that I believe the idea was to take the money, potentially reduce it, but block grant it to the state. So not have it run out of HUD, but say, all right, California, you can have X dollars to apportion how you want to do.
Welcome to the show. My name is Taylor Avakian of No Vacancy podcast, and I'm here with my esteemed guest, Geoff Moen. Geoff, thank you for being here. What is HACLA, and what is your role there?
Great. Well, first of all, thank you for having me, Taylor. It's really nice to be here. Really enjoy the podcast. I guess the first thing I want to say, because I think there's a lot of confusion about like what HACLA is, and it's the Housing Authority of the City of LA. That's what it stands for. What I think is interesting about it is that it's not a department of the City of Los Angeles. It's a separate legal entity from the city. The connection that we have to the city politically is that, you know, like a corporation has a board of directors, we have a board. They're called commissioners, and all of those commissioners are appointed by the mayor of Los Angeles. So that's our connection to the city. But, you know, we have a separate budget, we have separate processes, so we're able to kind of do certain things independently. They often call us part of the city family, and so we work very closely with the city. And of course, you know, it's very important to us that we're implementing the mayor's priorities. But basically, you know, what we're about at HACLA is building, creating affordable housing for people in LA. We focus only within the city of Los Angeles.
Okay.
So we use all these different tools that we have. I'm sure we'll get into that, but that's basically our mission. Affordable housing, primarily for people of lower income, very low income, et cetera. The other thing that I think we'll get into, and I'll just touch on, is we run the Section 8 program in the city of LA. That's a very big deal and a very hot topic right now. So we run the Section 8 program within the city, which has all the Section 8 vouchers. We have about 53,000 of those vouchers. We also have an entity that manages federal, what they call PBRA Section 8 contracts across Southern California. That's another 60,000 vouchers that we manage. We own and operate about 6,000 units of traditional public housing, and I'm hopeful we'll talk about that a little bit too. We're redeveloping some of those sites. And then, you know, finally, the thing is that I think we'll also talk about, we own a portfolio of kind of regular conventional multifamily housing. So we own about 3,500 units directly ourselves, and then we own about another 3,500 in partnerships with for-profit, nonprofit partners. And it's housing, you know, much of it is income restricted for lower income individuals. Some of it is market rate housing. So it's a mix of things that we do. We don't, I think this is kind of surprising to folks, is that we don't get like sales tax revenue, and we don't get property tax revenue, right? So how do we operate? How do we pay for ourselves? Well, we operate the Section 8 program. There's administration fees that we get from that pays for all the staff that work on that. And we manage the ones even that are, you know, across Southern California. That generates fees for us, which is great. But then we also have this real estate portfolio, right? And that generates cash flow. You know, some of it is leveraged, some of it is not, but that generates cash flow. And we use that to support our operations, to pay my salary, to invest in buying properties, to invest in building properties. So that generates income for us. So that's really how we kind of keep the lights on, and what it's a lot of what we're doing.
It's really a business. I mean, it's a business at the end of the day that you guys are providing a mission-based service for the city of Los Angeles, but you have to run it as a business as such, and understanding utilizing the tools that are available to a public entity like you guys. And we're going to dive in so much. I'm curious to know though, like, how did you get to where you are today? How did you get to being the head of development for HACLA?
All right. Can I go off on a tangent for about 2 or 3 minutes? Because I was hoping we'd talk about this, and I was trying to think about how to kind of talk about it succinctly. But, you know, what I'll say is, people get places, they don't know how they got there, right? It's kind of an interesting story. I think what I'll say is kind of to start is I grew up in Minneapolis, Minnesota. And if you've been there, you're familiar with it. I grew up in the 1990s there. I think that, and by the way, that's actually where the LA Lakers came from. I don't know if you know that.
Minnesota,
Yeah,
right?
they were the Minneapolis Lakers. So I've always been kind of a Lakers fan. Now I'm a Wolves fan, and they're doing great. But anyway, what I wanted to say about that is you probably remember this, and a lot of people remember that in the 1990s, a lot of central cities in the U.S. had become depopulated due to deindustrialization, disinvestment. You saw a lot of inequality. And in Minneapolis, we had 30 or 40% of the population decline after World War II. So by the time I was growing up, we saw the effects of a lot of that living in a city. And the reason I bring all this up is I think I had this kind of impulse like, gosh, we should really be trying to rebuild these cities. We should be investing. We have infrastructure. Cities are the engines of, I mean, you didn't really have the vocabulary for it as a kid, but you kind of had the sense like this is the engine of innovation, of economic development, of social progress, all these things that we kind of feel why we like living in cities.
Yeah.
So that was kind of my impulse, but I didn't really know what to do with it. My parents were public school teachers, but I was very interested in the field. Coming out of school, my first job, I actually ended up working in New Orleans, Louisiana through the mayor's office. I got assigned to the city planning department. So I was doing planning, post-disaster recovery planning.
Wow.
And it was about trying to help the city to rebuild. That was a very fun and interesting job, but I still had this impulse that I was kind of drawn to the business side of things and getting things done. When I was in college, I had been on one of the chairs of the entrepreneurship club. I kind of had that impulse too. I decided to go back to school. And I went to school on the East Coast for a master's program, but I kind of had the idea that I wanted to work in this affordable housing space because I had been really exposed to it in New Orleans because a lot of the focus was we want to rebuild and build units, but we need affordable housing too. And there was a lot of tax credits and things that came up around that. And so I kind of went in with that idea that this is kind of the field that I want to be in. And I really focused my time there on taking all the classes I could, networking, doing internships, et cetera, that were focused on that. And I kind of realized like, yes, this is a field that I really enjoy. When it came out, the excuse me, the job that I got, I worked for a national nonprofit affordable housing owner and developer called POA in Boston, POAH. And that was a great experience. To kind of make a long story short and not make it too boring, I was living on the East Coast. I was working kind of across the country, but not on the West Coast. At the time I was married, my ex-wife's family was out here in LA. We wanted to be out here around her family. So I came out here, and through kind of networking, I had got the opportunity to work for a company here that I hope a lot of your listeners will know, named Standard Companies.
Yeah.
I worked for Jeff Jager, working on doing what they call West Coast production, which is kind of running deals on the West Coast. Affordable housing, acquisition, rehab, tax credits, Section 8, all of that stuff I had been doing in Boston. I did it out here. But fast forward, and that was a fantastic experience, which I could talk more about. But this thing opened up at HACLA, which I never thought I'm going to work for a housing authority. The one thing I knew about HACLA was nobody was doing projects on the scale that HACLA was because they were working on redeveloping these major public housing sites. And I thought that's pretty cool. And so I kind of just decided, well, let me kind of look into it and hear more about it. And I heard from some folks I knew in the industry, like, yeah, they're really good. You should talk to them. It turned out that HACLA had kind of a very entrepreneurial mindset, wanted to do big things, and also wanted someone who understood kind of the business side really well because they wanted to grow through acquisitions and partnerships. And that was something that I had a lot of experience in. And I saw it for me as an opportunity to grow in managing a team that was also working on ground up development projects and to manage a very large team, which was a way for me to grow as well. And also to work with some new programs, work directly with public housing, which was something that I hadn't done, understand some of the federal programs and the state programs that deal with that. So that's really kind of what led me there. I had a great experience at Standard, but I just felt like this is a good opportunity for personal growth and to grow within California. And that's really what drew me to it.
Jeez, man. Well, it's funny how the public sector realizes that some people who've had experience in the private sector and who need to optimize every little thing to make the most out of it can actually benefit someone. You've had the experience, right?
Exactly.
You know what's going on. And that actually helps when you have someone who's done things. What can you explain the difference between public, private, and like nonprofit? What is the difference between those different entity structures?
Yeah. Well, a lot of people would say probably, sort of nonprofit is kind of a tax status, right? And to some extent that's true of government. I think in the public sector you have, in all these different things, you have different kind of powers and things that you can do. You also have different responsibilities. And you have to some extent, different tools. But when we talk about affordable housing, I've worked in public sector, nonprofit, and for-profit. A lot of the financing tools that we're using are the same across sectors. So we're using the low-income housing tax credit. That's one of the biggest programs. The Section 8 program is the most important program we have for affordable housing in the U.S., and people across sectors are using that. And then we have certain things in the public sector that we can kind of layer on top of that. There are other things like certain tax advantages, like in Los Angeles, we have the ULA tax on transfers. But if you sell to a housing authority or a public entity, you don't have to pay that. So that helps us.
Wow.
The other thing that we can do as a government that in the private sector you can't do is I can issue tax-exempt government bonds to finance things, right? So, normally you're going out and you're getting a mortgage for your property. And that mortgage is pegged to the treasury, usually, right? Depending on the term, et cetera. A lot of affordable housing, you're using tax-exempt bonds. If you're a private entity, there's only so many that each state can issue. The advantage is the rates are lower because the interest income the investors, pay tax on. But if you're in the government and you don't have private equity in your deal, I can issue those bonds and there's no cap on it. So if it's a public purpose to have housing, which it is, just like having an airport or a sewage plant or anything else, we can issue bonds, and that helps us get to a lower cost of financing. And I don't have to compete with other developers and keep them from getting resources because I can issue that as a government without having to deal with that cap. So that's an important tool that we have.
Let me ask you something. What are those bonds backed by?
Well, that's a great question. It just really depends, right?
Okay.
Sometimes people talk about something called general obligation bonds. You've probably heard about that.
Yeah.
That's basically like making a personal guarantee. That's when the government makes general obligation means all of your assets are at risk to pay the people that you borrowed money from.
Yeah.
We generally don't do that.
Okay.
Obviously, that's very risky.
Yes.
The other thing, usually what they're called is multifamily mortgage revenue bonds, meaning that like a loan that you would get, they're secured by the property, the interest in the property, right? And so we do that. Sometimes we go and get an independent credit rating. We did that with Fitch last December for some bonds that we issued. So we didn't guarantee payment, but Fitch looked at the deal and said, this is a really good deal. It's underwritten really safely. We'll give it an A rating. And that helps you to get an even lower interest rate on those bonds. Then some of the bonds are not rated at all. And you have investors in the bond market, almost like private equity investors, right? Because they're taking equity level kind of risks. They're looking at the deal very closely, and then they're deciding what kind of rate are they willing to take for that risk. And so that's how. So there's all different kinds of bonds. Is my point in saying that.
Does that change the timeline on, like, how does it work from closing a deal, right? Because if you're going to be financing it from bonds, typically you need to know that you can sell the bonds. There's a desire for those bonds. So how does that determine your length of escrow, or does that affect anything when it comes to actually purchasing a building?
It takes a little bit of time, but if I had to boil it down to its simplest thing, right? What's happening is the bonds are what they call them underwriters. They're investment banks that sell the bonds, right?
Yeah.
They're going to write up something they call an official statement. It's basically kind of a report about the deal and the bonds and what's being offered to investors. That can be done fairly quickly. I did a deal with Standard back in 2019, and we probably had the deal done and sold within 2 or 3 months.
Wow.
So you can do it very quickly. The last deal that I did at HACLA, it took longer, but the reason why is because we were also using a HUD program called Restore Rebuild, which we should talk about a little bit, where we were able to bring in some Section 8 project base to the building. But in order to do that, we had to get HUD approval. We had to go through certain steps that take a lot longer. So that took about almost 8 months.
Okay.
If we weren't doing that, though, we could have closed much faster. The point I'm trying to make, and I hope that, if there are people that want to sell us properties, they're hearing this, is that we can move quickly.
Okay.
I need to. The other thing I want to say about that, Taylor, is that, and I just kind of want to get this plug in for potential, sellers out there, is the other thing that we did. We talked about general obligation bonds and saying we don't want to put our general obligation credit on the line. What we did with our general obligation essentially was put it onto a line of credit that we have with City National Bank. And the advantage there is, if I have to close really quickly, I can do it all cash. And I can say, you know what, I'm going to go through the HUD process and I'll go through the bond process later, and I'll just close all cash right now. And on that, we're guaranteeing to make the payments. Now, we're doing it in a way, we're buying a building that can afford to make the payments.
Yeah.
But that way, we mitigate that risk by saying, if I have to close faster, I can do that. I want people to feel comfortable that if we say we're going to close, we're going to close. We don't back out.
What is the criteria that you're looking for when because you're not a nonprofit, you're a public sector, which means are you technically a for-profit that you want to try to bring revenue to the city from your operations while also providing housing? Like, you're trying to generate a profit, right?
The one distinction I would make is we don't make a profit in the sense that we are government and we actually work through nonprofit corporations that we create. We don't make a profit in the sense that no private individual owns our properties. We don't distribute dividends. So in that sense, it's not a profit, but we do have, you're right, cash flow.
Yeah.
We have what you might call retained earnings or surplus cash, right? But that is cash that we keep to be able to invest in the next deal and to pay our salaries, to pay for programming, for resident services. So it all goes back in some sense into affordable housing. In that sense, it's very similar to a nonprofit corporation.
Okay.
There's a mission motivation, but the basic idea is that no private individual owns the equity in the properties.
How does someone get involved in the public sector? Like, what does that look like?
You mean to partner with us?
Yeah.
To work?
To partner with you guys.
Well, one of the first things that, and I can't take credit for this, but because my boss, my current boss, Jenny Scanlon, who was there, had this idea, but we have a program called Innovative Partnerships, and it's kind of like an RFP. Technically, we call it a solicitation, but it was one of the first things that when I started, she was like, you got to get this up and running. And so what we did was to create this, essentially it's like an invitation, right, to for-profit, nonprofit, could be other governments, to say, well, our mission is we're trying to add affordable housing, right? We have certain goals that we're trying to do, deeper affordable housing, a lot of things that you would expect to see, more units, but we don't necessarily have all of the answers. Some people might have an idea about ways that we could be a good partner to them. We had ideas about things that we could do. And, we have, like, for example, we have a very competent team. We have a great team that works in asset management and development. We're very good at applying for and getting funds. We can invest money into projects. We can apply to HUD in certain cases to put project-based vouchers into projects. We were really looking particularly for projects that, might not be able to move forward, but for a partner like us that could come in and help to push it over the edge for whatever reason. To answer your question, it's an open and rolling solicitation. We have it on our website. If you just Googled HACLA Innovative Partnerships, you would see. You can literally download kind of like our the criteria that we have that we need to evaluate. You could put it together and you could literally send us an email with that as an attachment. And we've had many people do that. We've entered into about 8 or 9 of these partnerships so far. Some of it is buying property where we partner with private equity investors like a Vanif, which I don't know if you're familiar with that, but big national owner, private equity owner of affordable housing, naturally occurring affordable housing. We partner with a local group called Ethos to do some acquisitions where we take a market rate property and then we restrict some of the units for lower income people in the long run, for households that are below 80% or 60% of AMI. And there's a property tax exemption associated with that.
Got it.
There's certain things that you need to get that tax exemption. One of them is you have to have a nonprofit partner, so we can do that role. You have to have some kind of public money, so we can lend money to the partnership, or we can grant money, and that makes it eligible. And then you have to have people who are, lower income and they're living with and there's a regulatory agreement that goes in the property that we can put in there too. So we've done that. We've also partnered on the development side with developers, but basically it's all from people having an idea and proposing something to us. Because I'm public, I can't call you up and say, hey, Taylor, I've got a great deal for you. That's not fair, right?
Yeah.
Because I'm public sector.
Yeah.
But if you propose something to me, I can respond to it and say, let's talk about, does this work for us? How can we make it better? How can we, how can we make it so that everyone is, able to participate and we're getting as much affordable housing as we can for the city?
I might have some opportunities for you. I might have some opportunities for you, Geoff. Can we talk about Section 8 for a second?
Sure.
Because that is, over the last 12 months, I've dealt a lot with Section 8 properties. We've sold a bunch, and we've been a part of a lot of sales where a majority of the tenants are on Section 8 vouchers. Can you explain to me what is going on with Section 8? How are you guys involved? What's the difference between product-based and then individual tenant-based Section 8? Walk me through a little bit about that.
So, Section 8, just like, starting from like the broadest level, goes back to 1937 in the New Deal. They had something called the United States Housing Act, and a section of that act is called Section 8. The idea behind Section 8 was, let's have a program where people who are lower income families can pay 30% of their income towards their rent, and then the government, through what is now HUD, gives money to housing authorities to pay on top of that up to a certain level. That is, that increment is paid by the government, and that is called a housing assistance payments contract. So as a landlord, you'll get a Section 8 contract. A lot of you're familiar with this. A lot of your listeners.
Yeah.
That's kind of the basic level behind it. Section 8 is the most important program that we have to support affordable housing, right?
Mm-hmm.
The thing that it brings is assurance of payment, right? Because the government always pays its portion of rent. It always has, as the program has been in place. So a lot of people rely on that, and it's a very important program because the idea behind it also was, let's give renters and households choice where they want to live. So if you're a landlord, you have to attract people into your building, right? The neighborhood, the amenities, et cetera. They have to want to live there. They have a choice. That was the idea. So those are often called tenant-based vouchers, right? And we have about, like I said, something like 53 or 55,000 of them just in the city of LA that we manage. The federal law allows us as a housing authority to project base up to 30% of those vouchers. So we've got, 50 some thousand. We can project base, call it around 15,000 of them. What that means is we can take some of those vouchers and say, if you've got a building and you want to have 20% of your units, or 50% or 100% in some cases, right? Where everyone who lives there will qualify for a Section 8 voucher. You can have that attached to your property. Those are 20-year contracts. They can be renewed. The advantage to you, of course, is now you've got a contract that essentially guarantees your rent. It doesn't guarantee, but more people are comfortable underwriting that. And so that's a really important program that has been used all across the country to help build affordable housing in particular and preserve it, because a lot of these older buildings, and we manage those 53,000, like I said, through HACLA. There's another Section 8 program called PBRA that has, all across the country, that covers other units. Like I said, we manage about 60,000 of those, vouchers from an administrative standpoint at HACLA. What's happening right now is a couple of things. Right now we're operating, so the funding comes from the federal government, right?
Yeah.
It requires a federal law. It's a congressional act, which is the budget, right, that appropriates the money to pay for it. All the Section 8 contracts say, this is your rent. By the way, it's subject to federal appropriation, right? The government has always appropriated money to pay it. Right now, we're operating under a continuing resolution that, interestingly, actually added money to Section 8. So I think people are worried about Section 8 because a lot of stuff they're hearing, but we actually had an increase in the budget for Section 8, which is great news. Part of the reason to have that was because the rents have to go up every year to keep pace with inflation, right? And we had a problem where they hadn't raised the rents because there was a continuing budget from the previous year. HACLA was actually in shortfall, meaning that because they hadn't added more money to the budget, if you projected it out, we didn't look like we had enough money to pay all the contracts. And that's why we stopped issuing new contracts, because we had to make sure that we preserved money. Now, more money has been appropriated. HUD is still in the process of allocating it to the housing authorities, but we're hopeful that enough is allocated to us and the other housing authorities to allow us to issue all the vouchers that we can issue. Now, the administration has announced just recently that they want to block grant Section 8 to the states. I think there's a lot of, fear around that, rightly so. You'll never find a stronger advocate for Section 8 than the housing authority, right? But what I would say to, your listeners is, you guys are developers, you own real estate. It's a political thing, right? So use your trade groups, use your industry association, use your clout, and talk to congressional representatives, and not just in California, right? You got to get out into some of these other districts in the country and remind the legislators how important this program is. Section 8 is in every congressional district. There have been many proposals to cut it over the years. It's never happened. I should say not just to cut it, but to sort of eliminate it. That hasn't happened. And I think the prevailing wisdom in industry is that's because it's such a bipartisan, important program. So, we're comfortable and hopeful that kind of cooler heads will prevail here, but we'll have to see. It's a political decision. It's up to the administration, ultimately to Congress. So that's why I would say, we got to remind folks, get out there and talk to your Congress people and talk to other Congress people. Make sure that you're getting in front of them, because their votes are what is going to allow the program to continue.
So what they're proposing is potentially getting rid of Section 8. If that were to happen, how there's 53,000 people or landlords or tenants who, what even happens in that situation? Do we even know?
We don't really know. And I should say what they've, we don't have the details, but my understanding of what was proposed was not to eliminate it in totality, in the sense that I believe the idea was to take the money, potentially reduce it, but block grant it to the state. So not have it run out of HUD, but say, all right, California, you can have X dollars to apportion how you want to do. I think that was the idea.
Yeah.
I don't know. I don't know all of the ins and outs of it, so I can't really speak to that, but I think that was the idea. So I don't think we should expect that the idea was there wouldn't be any Section 8 whatsoever, but that it would change and be managed potentially in a different way. But, you're right. I mean, the real risk about it is that if it did go away or if it did shrink, I mean, we are using these vouchers. Right? People are living in these housing units. If if you had a contract, and the contract says, hey, Geoff, you got to pay me this money and I'll give you this housing unit in return for this time period. If I stop paying you, that contract is void. Right? So that's the real fear. And I don't mean to be glib about it. It's very serious. Ultimately, if the money isn't appropriated at some point down the road, you've got a problem where these contracts can't be honored. And then potentially you've got people that are going to lose their housing. That's the reality of it. That's why it's very important that we all remember it's a political process, and we need to get in front of the decision makers and remind them how important this program is.
It's incredibly important from my personal experience too, and how much opportunity it gives to people who otherwise would not be able to live in this city. That is a true 100% fact. I'm curious to know, so recently in 2025, the voucher limits, which you guys set, changed, and they changed on a county level and they changed on a city level. And so I'm curious to know, because that was a big conversation piece where people were either underwriting a specific rent that Section 8 was going to be, or they were expecting this, and now it's significantly less for different zip codes. It was kind of broken out by zip code now. Can you explain to me the scenario or situation with that?
I forgot that you're really well educated in the weed here. So but I'm glad you asked, because I think it's created a lot of consternation and I think confusion, right?
Yes.
But just for anyone who's interested in affordable housing and doesn't know as much about Section 8, what you're referring to is what we call the voucher payment standard.
Yes.
Right? The VPS.
Yes. And which is a save tab on my computer.
Yeah.
FYI.
It's right on the website, right?
Yeah.
You can go to it.
It's incredible.
But what I think is important to remember about the VPS is, a lot of people, I'm sure you know them, they'll look at it and they go, okay, here's my zip code. The VPS for a 1-bedroom is $2,500. Great. So I'm going to underwrite. I'm going to get 10 vouchers and I'm going to get $2,500. The thing that's important to remember is that technically speaking, the rent that you get in your contract is the lesser of the voucher payment standard or the market rent for that unit. So you're not guaranteed to get it. If the market is higher than the VPS, you get the VPS because that's the cap, but it's not the guaranteed minimum, if that makes sense, right?
Got it.
Now, for many, many years, there was one voucher payment standard, as you pointed out, right? For the county, for the whole city. Until very recently, you just went to the website. It was like, you got a 1-bedroom. This is the rent wherever in the city it's located. But years ago, there was a movement to say, well, does that make sense? Because some parts of the city have higher rents, some have lower rents. And part of our goal is to make sure that these housing choice vouchers, that people can choose to go into neighborhoods that the rent might cost more. So the idea behind it was, let's create what they call small area fair market rents. And that's essentially what you're seeing on our website now. A couple years ago, we started to implement the small area fair market rents, which, by the way, is now, what HUD uses across the country.
Yeah.
And the way that we did it was we kept that citywide rent for probably half or more of the city, something like that. And then we created 3 tiers that were higher than that level. And so if you were in the West Side or Woodland Hills, your rent under your voucher could be higher than it could have been in many other parts of the city. The intent behind it was always, hey, we're going to make the whole city be in a tier of a small area fair market rent, essentially a neighborhood-based rent. But that first year that we did it, we had 1 for the whole city and then 3 that were higher. And then the next year we came in and said, now we're implementing the whole thing. So some areas are actually going to be below what the citywide tier was, and some are going to be above. And so some people had properties in certain parts of the city where they were getting the citywide voucher payment standard this year, and then they were underwriting a deal for next year and going, okay, great, that's going to be the rent. And then they saw, now based on my zip code, the rent is lower. So that was really the idea behind it, and that's really what happened. To finish that out, we had lowered the rents fairly considerably in certain parts of the city. And it's not so much that we lowered them as that's what the market rents were. HUD reports on that. We kind of had to go with that. But we did then, after we released that and realized that was creating a lot of problems, we went to HUD and said, could we actually adjust this? So we did raise the rents in some of the lower tiers to get them higher, because obviously the most important thing is that people are getting housed, and we want to create a lot of difficulty in the market around that. But that's really the idea. Is I think long run, we should be thinking about the fact that we do need to have this small area fair market rent system. That was the idea behind this program in the first place. So that idea, I think, is here to stay. But we always have to try to sort of adjust it to make sure that it's working across the city.
How do you determine the amount that a unit is going to be allocated per the renovation status? So what I mean by that is, you said that is the upper limit of what someone can get for that, but they can get below that, right?
Yes.
Depending on whatever that market rent is. How do you determine if I have a vacant unit and I want to put a section 8 tenant in there and my voucher limit is 25, how do I know if I'm going to get 21, 22, 25? How can you determine what the actual amount is going to be?
Well, I'll tell you, my philosophy on it is, if you've got a building and you've got 50 units or 100 units, you've always got some natural turnover, right? You renovate a unit, you put it on the market, you know what the market rent is, right? A good data point is, what am I getting in this building if I don't have the Section 8? What's the market, right? So you know that. So that should be your gut check. Is like, don't think you're going to get necessarily more from Section 8. I mean, you could. The market is always changing, right? But to answer your question directly, we actually, I should say, we as HACLA use a third party to do rent comparability studies. So what they're going to do is look at other properties in the same neighborhood or nearby, similar sizing, and they try to make adjustments for amenities and different things. But that's how they try to calibrate so that it's a reasonable thing. If someone challenges, is to say, look, here are the comps. This is how we got to that number. And that's what they're really going to do. If you're in a neighborhood where you could look at 10 other buildings that are very much like yours, and they all have rents that are higher than the voucher payments they are, there's a very good chance you're going to get that maximum VPS rent.
Why is county different than city?
It's a good question. The county is run by a different housing authority. It's called LACDA,
Okay.
Los Angeles County Development Authority. And I think really the answer, well, there's a couple of different answers to it, but one is, we're talking about different geographies, and so
Yeah.
they're when they're looking at small area fair market rents, it's not in the city, but they also have areas that are getting higher rents and areas that are getting lower rents based on where they're located.
Okay. So so that entity is like HACLA, but for the
Just for the
county.
county outside. By the way, I do want to tell you one other thing about this, if it's okay, just
Yeah.
a digression on
Yeah.
this, which is because I think that, it says something about HACLA and also about this Section 8 issue for landlords, but it goes to this rent
Yeah.
issue, which is over the past few years, you're familiar with this. We bought a lot of brand new buildings. We use this
Yes.
program called Home Key, which was a very interesting and great program. We use that to buy brand new buildings, and we're able to put unhoused people, in some cases coming from encampments. Some people are living in cars, all kinds of different situations, but able to get them housed very quickly. But in most of those buildings, we had a Section 8 contract that was project-based to the units, right? And that we used that to be able to, well, we bought the buildings on a line of credit together with the state money. We took that risk, but we had underwritten what kind of permanent mortgage are we going to be able to get. And we used the voucher payment standard rents. And our thought process was, hey, these are brand new buildings, right?
Yeah.
Of course, we're going to get the voucher payment standards. And so what I just want to convey is, like, when we did it, and I'm talking about the housing authority itself, we own these buildings.
Yeah.
In some cases, when the rent comp studies came back, we didn't get the voucher payment standard rate.
Wow.
We were 5-10% off. Some buildings did get it,
Sure.
but not all of them did. And so, those were brand new units
Yeah,
that had never
wow.
been lived in. So that, it's just something that I think people have to think about, and I would build a little bit of cushion
Yeah.
into your underwriting. And that's something we had to learn the hard way ourselves.
For sure. It's just, which is funny. You guys are managing it,
Yeah.
yet like you're still beholden to the standards that people
Standards,
set.
yeah, exactly.
What happens when last year your voucher payment system was 25 for one bedroom, and now in that specific fair market value, it's 22? What happens in that scenario where the current tenant has a voucher that's paying them 25, but then if someone moves out or they're currently in there, are you honoring that current rent and that voucher payment, or should landlords be expecting that to drop?
No, I think what they should be concerned about is when there's turnover. We don't lower the rents on people that are
Okay.
in the units. And most of the, you'll see that written into the contract to have language to that effect. And we check that box on our project-based vouchers as well. But it really is an issue when a new unit comes up for rent, because we can't approve a rent that exceeds the voucher payment standard for a new contract in that unit.
Got it. Okay. So basically, when I'm seeing that too in some buildings that I'm selling, it's a negative pro forma, as in they've had rents that were at the higher voucher limit and the lower voucher limit is lower. And so we can't underwrite if there's vacancies for that limit. So they're buying a property that when turnover happens, the cap rate is going to be lower, which is typically not standard in the city of Los Angeles. Mostly, the rents are below and you can increase it. So it's very interesting. I've never seen it before. So it was something where we had to, like, okay, what is the appetite for something like this? And it's been interesting to see the feedback. There's definitely a risk tolerance for someone like that. Like you have to price that risk in terms of cap rates, which I want to talk about homelessness, because that has been such a politically hot topic in not only the country, but California, the state of California, and the city of Los Angeles. Like, what is your take on the current homelessness situation? Why does it feel like it keeps getting worse? The budget for homelessness keeps going up. Like, what are we doing wrong, or what needs to be fixed?
Well, a couple of thoughts on that. Because what is driving homelessness, right? A lot people have different theories about that, but there have been some studies about it. Some of it is mental health.
Yeah.
Some of it is addiction.
Yeah.
Right. A lot of it is just good old fashioned poverty and inequality, right? People have differing studies and data about how much is causing each, component of it. But I do think it's important to remember that there are a lot of people in our city and in our country who, if they have an economic shock, they lose their job for a couple of months, their car breaks down, they don't actually have the resources to get through it. And so for a lot of us, it's hard to remember. A lot of our fellow citizens are in that situation, and some of them don't have families and friends that can go to, or they can only go to for so long. And so that, that is certainly part of what's, driving the problem. The other thing I would say is, I tend to look at the world through an economic lens. I mean, I think to be in this affordable housing space, I'm mission oriented. Everyone is. That's important, right? But I think you have to understand, the economics of it. And I think that
it's a business.
the economists and the accountants kind of see the world in the clearest terms when you think about it, right? Because everything has to be on the ledger and everything is a trade-off, right? So I guess the reason I bring that up is to say I think it's always helpful to quantify the problem, right? And you've probably thought about this. You're in the business. If we've got people living on the street and we want them to live in housing, as we do, what does that cost on a per unit basis? And then multiply that out. We count every year. We do a census. I was in it a couple months ago. They go out across the entire city in the county and check and count how many people are unhoused in the city. So we know what that number is, right? And then you multiply it out. What would it cost to house these people, right? And then, of course, there's also, they need rental support. They need services. Obviously, that's very important, and that's very expensive. I guess the reason I bring it up is to say, if you did that, I think what you would see is that it's a very large number, to state the obvious. Have we spent a lot of money on homelessness? Of course we have. But if you compare the number that we've put in our budgets to deal with it relative to the magnitude of what it would actually take to eliminate it, I think you would see there's a very large difference.
Interesting.
And the other thing that I would say about it is, this was kind of hurtful in a way. There was a local publication maybe a year or so ago that wrote some articles about what we had been doing in the Home Key program and saying that we were overspending money on this. And I had certain issues with the way that was presented. But I think the broader point that I would make is, did we spend a lot of money? Yes. But did we spend it efficiently? I think that we did. We were able to buy housing units on average at $400,000 a unit, right? We housed thousands of people. And by the way, HACLA was the largest user of the Home Key program in the entire state of California across the first 3 rounds, and the LA County was the second. So we have brought in as much of the state resources as we can. And I just want to point out, we have housed thousands of people. That is an important accomplishment. I don't think that we should take away from that or feel bad about that. That was a good thing. If our goal is we want everyone to be housed, and I think a lot of us feel that way, it is going to take more resources. We have to be honest about that. It's going to take more resources, and we have to use them efficiently, and we will do that. You can trust me. I'm telling you, I will use them efficiently. We go after the money. We're very cognizant of the fact that it's public money and it has to be used efficiently. And by the way, the other thing about it, which is great, is I would say to this administration and to everyone that isn't it wonderful that we're able to buy a building that's produced in the market so that the developer who took a lot of risk is able to recycle that capital, pull money out, maybe do another project, show to the market, hey, like there's a way to sell your buildings in LA, so that we're stimulating the market to produce more housing. That's the other thing that we're trying to do. We're building it. We're building it with the tax credits and the other programs. But shouldn't we also use these other tools that we have and buy buildings that stimulates the private market to produce more? So we're doing that as well. And I guess what my point is like, yes, we are using a lot of resources. The other thing I would say is, to be honest, like, a lot of people feel like it's not getting better, but it is. What we did, the homeless count, it is going down. So it costs money, but everything costs money if you want to make a change in the world.
100%. So then this is something that I've been thinking about too, and we talked about this a little bit before, but so obviously these are headlines, right? So take them with a grain of salt, but there's a little bit of truth to that as well. So everyone's seen the $1 million per unit homeless housing development that was built. It cost $1 million per unit. People are like, what the hell? Oh my gosh. When we can't sell buildings, these older 1920s buildings, for $110,000. And the thought process, logically, I think most people would say is, well, why don't housing authorities just buy the buildings that are $110,000, $120,000 per unit and put, that seems like a 10x less cost in terms of building. Yeah. So one, I guess two-pronged, like, why are the headlines coming out that it's costing $1 million per unit to build homeless housing? And why are those funds not being diverted to going and purchasing up buildings that cost significantly less, which obviously you were doing, but like, why does that even exist?
Well, If I could take the second question first,
Okay.
because it is kind of counterintuitive. And I had that same thought when I started HACLA, it's like, hey, like, let's buy the least expensive
Yeah.
units on the market. But I think that a couple of thoughts. One is, um, when we buy units, people are already living in them. And a lot of the focus on public resources is how do we create new units, right? So the point I'm saying there is that a lot of the resources are driven towards production and construction logically, right? So we don't have the same pool of resources when it comes to acquiring existing buildings. The biggest resource I have is the bonds, like we talked about, which is basically borrowing money to buy buildings, right? And then as units turn over, we move people in at different income levels. The rest of that is our money, essentially HACLA's equity, like we talked about, money that we generate by owning properties. So we have to fill that gap just like any other buyer or investor would. But the other thing about the $110,000 buildings, is that the reality that we all know is that part of the reason they're $110,000 is because they're very old and there's a lot of deferred capital needs. And because we don't have tax credits as a source, you generally can't get tax credits for a variety of reasons to be able to acquire and rehab those buildings. We don't really have a good source, right? Because we're trying to keep the rents low. We can't just, a value add investor would say, that's fine, I'll buy it, but I'll fix up the units and then I'll get more rent and I'll invest equity for that purpose. But we have very limited equity and I don't have a source to pay for the rehab. The other thing that I think, put yourself in my shoes, is like, I'm a public entity, right? If I buy a building from you and, the second I take it over, I got the keys, people are going, oh, now the government owns it. So every problem that's there is a public problem. And people, rightly, they want it fixed right away. And if we don't have resources to do it, that creates a problem. And there's a different, I think, level of expectation sometimes when the public sector gets involved. And for that reason, that in some cases motivates us to say, well, let's buy a building now, put the financing in place that's in good shape so that we can hold this without having to invest $40, $50, $100,000 a unit and hold it for 10, 15 years until we can refinance it, take out some equity and put some of the, put a new roof on. Maybe we have to, there's all kinds of things that you have to do to buildings. When you talk about the $1 million a unit, I mean, that's a hot topic, right? What I would say about that is two things. One, we have done a couple of development projects that are over $1 million a unit now at HACLA. Those projects, and we're partnered, by the way, with some top-notch private developers, related companies, Bridge Housing, Michael's organization, fantastic organizations. Why do those cost $1 million a unit? I think that's a headline that nobody likes.
Yeah.
But when we've done it, it's been part of these public housing redevelopment projects, right? And what does that mean? Well, part of it is, and by the way, have you been down to Jordan Downs and Watts? Have you seen it?
No.
I think you should come out and see it because it's a beautiful.
I'd love to.
It's a beautiful community, and the work that has been done there, I think, is really wonderful, and I would really love to show it to you.
Yeah.
But the reason I bring it up is that if you go to our public housing, it was built in the 1940s, 1950s. The buildings are past their useful lives. What does that mean? We have to demolish the buildings. The buildings are also, like a lot of the land in LA, there's stuff in the soil. Well, we have to remove a lot of soil. That's very expensive.
Remediation.
The other thing that people may not be aware of, or maybe they are, is that when these housing developments were built in the 40s, they had a different philosophy. They didn't even put streets in. They don't have basic infrastructure like streets and sewers the way that we have, the way that we built other parts of the city. So when we go in to redevelop it, we want to have streets and infrastructure and all that. Do you know what it costs to build a street? I mean, it's very expensive.
Yeah.
So I'm saying for our projects, that's a part of why it costs $1 million a unit. Another part of it is when you're using public funds like from the state, which we all have to do to build these projects. We have to pay prevailing wage. Everything is trade-offs. I mean, is it wrong for construction workers to get paid a living wage for the work that they do? I mean, it's not, of course, right? But it does cost more than it can cost, to build other projects in the market. And so the other thing, we use a lot of different financing sources, and there's very high soft costs, legal fees that go into doing that because we have to cobble together a lot of different funding sources, right? And, the other thing is that a lot of people don't always realize is in the affordable housing space, when we're talking about new construction deals, developers are doing this for a fee, right? They have to get paid a fee because they're income restricted. They don't throw off a lot of cash flow, and you have to use some of it to pay back some of these soft loans, you get from the state.
Yeah.
But those fees have to be paid and capitalized. And even the part that isn't paid up front shows up on the sources and uses as a use. And people, so some of it is paper in that sense. It isn't all cash, but you're right. It is a very high number, but there's a lot of components that go into doing it right. And it's public money. There's a lot of politics. Everyone needs to do things a certain way. And that's kind of how it all comes out.
If you had to build a system, a better system than what's currently the situation with affordable housing, homelessness, the way that these deals are funded, like how would you build a system? What would that look like? Have you ever thought about like what's the most efficient way for us to provide as much affordable housing as possible?
Yeah. Well, look, I mean, I'm going to give you a little bit of a political answer.
That's fine.
I have to,
That's fine. I get it.
But I would say this, I think that especially now there's a tendency to kind of want to oversimplify things. That's a human intuition. Like, just tell me, like, give me one simple thing. I would say it doesn't necessarily have to be one thing or either or, right? I think that, building and adding to the housing stock is very important. It's expensive. A lot of this isn't rocket science. We can remove barriers. Like, I just read Abundance by Ezra Klein. Talk a lot about this. We all know this. If we relax zoning, CEQA, there's a lot of topics that we could talk about that we could make it easier to build. That would maybe bring the prices down a little bit. So I think the traditional kind of tax credit program is very good. And with more resources, there are things that have been talked about for a long time, like lowering the percent of the deal that has to be financed with private activity bonds. There's a lot of things that you could do to tweak to make that program produce more. And so that would be important. I think Section 8 is the most important program in the country. So when we talk about advocacy, it's not just preserve it, it's how do we expand it, because that helps stimulate the private market as well. And then finally, when we talk about on the acquisition side, I mean, when you think about it, if we're paying taxes, I mean, the federal government could take that tax revenue and distribute it to the states or housing authorities or whatever to say, let's set a target for you're going to buy X number of units every year in the market. And that incentivizes developers to build more as well. You're not going to buy every unit that's produced, but maybe you're going to buy a certain amount, and people are going to say, hey, if I build something that meets these criteria, a certain kind of bedroom mix that is important for the city based on its needs, like maybe I can sell it that way. I think that would be an efficient thing to expand upon. Right. So I'm not saying let's get rid of the tax credit program. I'm saying let's expand that, and let's also think about how we can build on this other tool set that we have.
Why? So I'm part of this organization called ULI, and we sat with the city when they were coming up with this new CHIP and AHIP and MIP program, which is the kind of the zoning that they changed for the city. They said in that meeting that we're about 400,000 homes short, right? And again, who knows what that number is, right? But it's a lot.
Yeah.
And if you think about it, it's almost impossible for us to get to that number when they're in their time frame, especially with how long it takes to actually get these things built. Are you involved in that at all, or like how do we fix the actual sheer volume of buildings which brings me back to ULA a little bit, because obviously ULA is very beneficial for you because it gives you an advantage when you're buying buildings. But for everyone else, they're like, oh shit, like this is, I don't want to build because it doesn't, HACLA can't buy every new building that's being built. So how do we fix the shortage of the housing situation? Are you guys involved with that, or what's the situation there?
Yeah, it's a little bit complicated because you're right. ULA benefits me or HACLA as a buyer, obviously, and I have a responsibility to the public to use every advantage that I have, right? But there's a broader question economically about what does it do to incentivize or disincentivize investment and production of new housing, and people have released different studies about that. And I'm probably not the most qualified to speak to that. I will say that the voters of Los Angeles chose to do that. We don't really get involved with politics at that level of sponsoring legislation. I think it's fair to say. Um, when I think about what could we do to talk about the 400,000 units, I think about things like, how did we build millions of housing units in this country in the first place, right? One of the biggest things that we did was create the federal agencies, Fannie, Freddie, the Federal Housing Administration. And, to state the obvious, if you could bring down the cost of capital and make it easier to leverage to build, I think that would stimulate a lot of production. But I understand, you're totally right. I mean, it is very risky to build real estate, and that risk has to be compensated with a certain kind of reward. And if people are looking at it and saying there's no reward in it left for me, they're not going to build. It doesn't make sense. They'll do something else with their time. So we have to lower that cost of capital and incentivize the market to produce housing units as well. But it's not, to my mind, that's a much broader, kind of federal policy level, state policy level. Ultimately, you'd be talking about, like providing programs that would have a lower interest rate, perhaps for construction loans. We have that marginally for affordable housing, but that's really what it is the cost of capital and the ability to leverage more, I think, is what would incentivize a lot more people to build.
What is your goals? What is HACLA's goals for 2025 and moving forward? Like, do you guys set yearly goals, yearly targets? What are your current outlays looking like right now?
Well, it's funny you ask that, because we don't have a numerical goal right now for acquisitions. I think the idea is, let's do as much as we can. I don't want to sound like a cop-out. I mean, part of it is you want to be nimble and flexible, right? We're trying to use the resources that we have to do as many units as we can. Last year we bought about 500 units. But do I want to say we're going to do that every year? I think it'd be great if we could buy 1,000 or 5,000, but that I don't realistically have the resources to do that right now. But we're always working on, how do we bring in more resources? I mean, in the background right now, I spend a lot of time working on how do we borrow more? Can we get other types of investment? Are there other resources from the city and the state that we can use to help us cobble together to do more stuff? So the answer is, as much as we can, which doesn't sound good, but we did 500 units last year on the acquisition side. We built a couple hundred units. I talked about Jordan Downs. That's a fantastic community. That was 700 public housing units.
Wow.
And the plan that we created was, we're going to rebuild it with 1,600 units. Some of it's market rate. Mostly it's affordable housing, 1-for-1 replacement of public housing. We're more than halfway through it right now. We built a new shopping center in Watts, which is a beautiful thing and has brought commerce into the community, and it's a gathering place. So, but we're doing as much of the redevelopment as we can based on the resources we can get access to, but also everybody's got to eat. All the other developers have to get resources too. So, I want to do as much as we can, but to also make sure that we have a healthy housing ecosystem in the city. What it means is figuring out how to expand upon the programs and the resources we have now, but also create new ways to finance. And that's what we are spending a lot of time thinking about. How do I bring in other money that's not in this space right now that we can use so we can buy more units, so that we can build more units?
Interesting. If I wanted to sell a building to you guys right now, right, or help a client sell a building to you, what is the current buy box? What does it look like? What are your guys' kind of requirements?
Yeah, well, I would say, so on our website, I have a whole list of like different criteria. I would encourage people to just go to HACLA, just Google HACLA acquisitions, and you can see that. But if I could highlight a few things, that are important to us, I would say, unit count, very important, right? There is tremendous need and a lot of political pressure to deliver units. So I'm very focused on, I'm probably not going to spend a lot of time trying to buy a 20-unit building, right? Because in some sense, it would be the same amount of work as buying a 200-unit building. I need units. Like you just said, we need 400,000 units. So I have to focus on larger properties. That's one thing. The second thing is, historically, we talked about the Section 8 program. We've had a lot of people with Section 8 vouchers that couldn't use them, and they couldn't use them in certain neighborhoods. So what our mindset has been and other owners have taken this mindset too, is we want to be a landlord to our Section 8 voucher holders so that they can always have a place to live. Why is that important? Well, if you have a Section 8 voucher and you're one person, you can live in a studio or you can live in a one bed. Most people would prefer to live in a one bedroom unit given that choice, right? What does that mean for me? It means that I'm trying to buy as few studios as I can. I think that's counterintuitive too.
Got it.
But I'm trying to buy units that are 1s and 2s on our Section 8 waiting list. Most of the demand is for 1 and 2 bedroom units. We also need family units, 3s, some for, small numbers.
Yeah.
But primarily it's 1 bedroom and 2 bedroom units. So that's what I'm going to be focusing on. We talked about the voucher payment standards.
Yeah.
We had a policy that we would like to have units in areas of higher opportunity, the higher voucher payment standards. Again, because our Section 8 voucher holders, when we look at the map, generally, for whatever reason, have not been able to find housing in those neighborhoods as much. So we bought a deal in Woodland Hills last year. Part of the motivation was we've got people that want to live in Woodland Hills, but there's very few opportunities for them to be there.
Okay.
And so that's the other thing I think I mentioned to you once before was, I think it's counterintuitive, is, we like to have some parking in our buildings.
Yeah.
It's not very attractive to have no parking. And I know that can be kind of anathema to the urban planning, kind of group that is very pro, hey, we've got to get away from this car culture. But the reality is, working people, a lot of them need to take cars to their jobs or whatever.
Yeah.
And so there's actually a lot of demand for parking. So I'm not saying we have to have two spaces per unit, but I also at the same time, it's very hard for us to buy buildings that have no parking because we know in our portfolio that we have a lot of demand for parking.
How are you pricing cap rates, GRMs, price per unit? Like, how do you look at the actual deal level metrics? And I assume that's depending on what your financing is going to look like or the spread. So what does that currently look like?
Well, we joked, I'm always looking for a good deal, the highest cap rate I can get. But when you think about it like this, I think that the blessing and the curse that I have is I don't have a lot of equity, right? Meaning that I'm leveraging very high in my capital stack. And with that, and I can get a little bit better rate than anyone else can because I have the ability to issue tax-exempt bonds. But ultimately, when you think about it, it becomes a cap rate exercise for me.
Yeah.
Also, because we're public sector, we have a property tax exemption. But when you think about it, I have to use as much of that tax exemption as I can to provide affordability, right? And so if I buy a market rate building, I'm going, okay, well, I have to get as many 80% AMI units and 50% AMI units and 30% AMI units as I can in there. So I can't just not provide affordable housing. Our whole goal is to provide affordable housing, right? So I say it to say that it's primarily the way that I think about it is driven by cap rate.
Okay.
And I'm looking for, as everyone is, a good opportunity to maximize my ability to bring units online that don't need a lot of capital intensive work, like we talked about, at the highest cap rate I can get. And that's ultimately what it comes down to, But I realize the cap rates depend on neighborhood and various factors. We want to be in Woodland Hills or the West Side. That's going to be a different cap rate than, downtown or certain other neighborhoods. So we try to look at all that. But ultimately, Taylor, we're paying fair market value. The deals have to appraise.
Yeah.
And just so everyone knows, if they don't appraise, I have to walk away. A couple of times I've had to walk away because we thought we had the right price for a deal. We went into due diligence. We got an appraisal. Didn't appraise. I had to say, I'm sorry. I can't go out and get another appraisal. Like if the appraisal doesn't appraise, I'm out.
Interesting. Okay. And so you still are active. You guys are looking at deals. You're dealing with everything that's going on in this market. And so your focus is still finding the capital sources and growing the portfolio. Like that is the mission that you specifically are spending a lot of your time doing.
Yeah, I mean, that, and I just want to say this so folks understand, also, that's 100% right. Also, the development deals with our partners that we're doing, both on the public housing side and outside of that. And then on the capital side, I have a capital markets team within my department that does bond issuances, that does line of credit, that does agency financing, all that stuff. So we're working on all these things simultaneously, just like any other kind of big development shop would be doing. And one thing I do want to say on that, I was at a conference, I think it was last week, and Ken Lombard was speaking. I don't know if you know Ken, but he's the CEO of Bridge Housing, one of the biggest, nonprofit housing developers in the country, and they're our partner on Jordan Downs. And he said something, and I was like, dang it, that was exactly the right way to say it. But what he said was, and I want to say it about our team at HACLA to your audience is, I look at it as, you know, I want this organization, if I'm a part of it, to have a culture of excellence. And I think that we do. And why do I say that? I say it to say, like, I don't want people to think, oh, geez, like it's a nonprofit, it's a government, it's going to take them very long, that maybe they can't execute. We've bought like 40 deals in the past few years.
Yeah.
And once we go hard, we always close.
Mm-hmm.
And I think that reputation speaks for itself. But I'm just trying to point out, like, we can be a great partner and we can also be a great buyer. And I want people to realize that we take that very seriously. I take it seriously.
Mm-hmm.
My bosses take it seriously. Our board takes it seriously. My team takes it seriously. If we have to talk about something at 8 o'clock on a Sunday night,
Yeah.
if you got my cell phone, we can
Yeah.
do it. I want to make sure that, partly because, like, it's an interesting field, it's something I care about, and like I said, I want to be associated with excellence, but it's also important to all of us. Like, it is public money, like, you guys should get a good deal for it. But I want people to know that if they're dealing with us, they're not trading on the ability to execute or anything else. You've got a good partner here.
Which is so important, because I think the typical thought process is the government is slow, right? They're inefficient. They don't care. They're just there to collect their paychecks, which is clearly not the way that you've approached HACLA and the business, and the way that you guys run that, which is a breath of fresh air for me personally. And dealing with housing, as it is an issue across the state of California and the country. So I love to hear that. I'm happy that that's the case. And I love that I can send you a deal at, Sunday at 8 p.m. and you're going to get back to me as soon as you can, which is great. One thing before we wrap up, I want to touch about the hotels and motels when home key was going on.
Yeah.
Is that still a thing, or like what's going on with that aspect of HACLA?
So yeah, Home Key has had a few rounds of funding. Now it's in a round called Home Key Plus, but they had 3 rounds before that. In the first round, HACLA, both for ourselves and in contract with the city of LA, bought a bunch of hotels, which I think is what you're referring to. The thing about hotels is they're cheaper to buy, right? But they really can only function as interim housing because they're not full-on apartment units. And in some cases, we took the hotels and actually converted them into apartments.
Wow.
We took we have in partnership, we did this actually not too far from here, in Canoga Park, and we also did it in North Hollywood to a Best Western, and that's great, but it's very time consuming, and it's very expensive, actually, as I'm sure you're aware, to convert a hotel room to a full apartment. So to answer your question, after that first round, we focused more in conversation with the city of LA on, hey, we need to buy apartments, right? So that they're, like we talked about earlier, they're good to go now, and we don't have to worry about converting them later. People can move in the next day. So we really focused on buying apartments. The city of LA, again, separate from HACLA, but the city of LA they are very focused on interim housing, and they are, in some cases, they're master leasing hotels. They purchased a hotel in the city last year that we're asset managing in partnership with them. So it's quite possible that we may be doing more of that. At the moment, for HACLA ourselves in our portfolio, we're focusing on multifamily apartments right now. But I don't want to, it's certainly possible that, we might be looking at hotels again in the future, but we're not right now.
What is one thing you want to leave the audience with, or maybe something we haven't covered that you feel is important that is discussed? Is there anything that we haven't talked about, or anything? You mentioned something previously about some programs, or is there anything that you want to leave owners, operators, brokers, investors in the Los Angeles area with that is something important?
Yeah, I mean, it's really 2 things that we kind of touched on, but I just want to reiterate. Is like, I think we want to be approachable and we want to be a good partner. So, I'm hoping that talking here with you, and through you, I'm conveying that, and I'm getting access to people if they want to reach out. Like, we're very much always, I don't have to have all the best ideas and the right ideas. I want people to tell me, hey, this isn't working, or we need to do something like this, or let's think about that. So I want us to be approachable and focused on whatever it takes to maximize, the number of units and the mission that we're trying to accomplish. And then the second thing is, the Section 8 program, and just getting out there and lobbying and letting folks know. I think a lot of people are feeling very, very fearful about what's talked about with Section 8 right now. And I think it helps us all if we feel like we're taking some action when we're afraid, right? What can I do? The thing that you can do is to get out there and be active and talk to some of these Congress people around the country. We're doing that, but we're a housing authority and we have a vested interest. But I think the people on the other side of the business who own buildings and understand the importance of Section 8 program actually have a very strong voice with politicians. And so I would say we'll be a partner with you in that, but it's really the owner community that has to get out there and make that pitch.
I love it. Geoff, thank you so much for being here. This was great.
Thank you. This was fun.
Perfect.